Quick heads up, this video is for educational purposes only and is not professional financial advice. Do your own research before investing. Amazon trades at $240.14 today. Our discounted cash flow model puts fair value at $92.50. That is a gap of roughly 160% between price and intrinsic value. 94 analysts cover this stock and 89% of them say buy. So who is right, Wall Street or the math? Amazon.com. Ticker AMZN. If you have bought something online, streamed a show, or used cloud software in the last decade, you have almost certainly put money in this company's pocket. Founded in 1994, incorporated in Seattle, Amazon went public in May of 1997 and never looked back. Today it employs 1,560,000 people worldwide and carries a market cap of $2.58 trillion. But Amazon is not one business, it is three. The North America segment is the retail engine most people picture: the boxes, the Prime memberships, the same-day delivery. The international segment extends that model across borders, still chasing profitability in many markets. And then there is Amazon Web Services, AWS, the cloud computing division that quietly powers a massive share of the global internet and throws off margins that retail could never dream of. Amazon also sells its own devices, Kindle, Echo, Ring, Fire TV, and produces original content. It runs one of the world's largest advertising platforms. It enables millions of third-party sellers. The question is not whether Amazon is a great business. The question is whether it is a great stock at today's price. Over the past 254 trading days, AMZN has carved out a wide range, swinging from a 52-week low of $196 all the way up to a 52-week high of $278.56. Today's close of $240.14, up 3.2% on the session, puts the stock roughly in the middle of that range, well off the highs but comfortably above the lows. The moving average picture is constructive. The 50-day moving average has crossed above the 200-day moving average, forming what technicians call a golden cross, a classically bullish signal that suggests the intermediate trend has turned in favor of the bulls. Price is holding above both averages, which adds further confirmation. RSI momentum is sitting in neutral to bullish territory, not overbought, not oversold. That means there is room to run without an immediate technical ceiling pressing down. The chart is not screaming danger, but it is also not screaming bargain. It is telling you the market believes in Amazon's story, at least for now. Revenue at Amazon has been a one-way street. From $469.82 billion in 2021, the company grew the top line to $513.98 billion in 2022, then $574.78 billion in 2023, then $637.96 billion in 2024, and $716.92 billion in 2025. That is cumulative growth of 52.6% in 4 years. A business doing over $700 billion in annual revenue and still growing at that pace is genuinely rare. But the real test of a business is not revenue. It is what falls to the bottom line. And here the story gets more interesting. In 2022, Amazon posted a net loss of $2.72 billion. That was a reset year. Investment cycles, macro headwinds, and margin compression all colliding at once. The recovery was sharp. Net income rebounded to $30.43 billion in 2023, then exploded to $59.25 billion in 2024, and reached $77.67 billion in 2025. EPS followed the same arc, from a loss of 27 cents in 2022 to $7.29 in 2025. Margins today reflect a maturing, higher-quality business. Gross margin sits at 50.3%. Operating margin is 11.2%. Net margin is 10.8%. AWS is doing the heavy lifting there. Free cash flow tells a more nuanced story. After burning $14.73 billion in 2021 and $16.89 billion in 2022, Amazon generated $32.22 billion in 2023 and $32.88 billion in 2024. But 2025 saw free cash flow drop sharply to $7.70 billion, a signal worth watching as capital expenditure cycles intensify around AI infrastructure. The balance sheet shows a debt-to-equity ratio of 0.37 times, conservative. The current ratio is 1.05 times, barely above water for near-term obligations. Return on equity is 18.9%. Solid, though not exceptional for a company of this scale and ambition. Based on our discounted cash flow model using a 10% discount rate and a terminal growth rate of 2.5%, our fair value estimate is $92.50 per share. The stock is currently trading at $240.14, meaning it is significantly overvalued by 61.5% on a margin of safety basis. That is the base case. The bull case, which assumes stronger AWS growth and sustained margin expansion, pushes fair value to $106.37. The bear case, slower cloud adoption, rising competition, continued free cash flow compression, brings fair value down to $78.62. Even under the most optimistic scenario, the current price is more than double our intrinsic value ceiling. The valuation multiples echo the same message. Amazon trades at 31.7 times earnings, below its own 5-year average of 43.1 times, which is actually a relative improvement. Price to sales is 3.4 times. EV to EBITDA is 15.3 times, not outrageous for a cloud-weighted business. But price to free cash flow is a striking 319.6 times, reflecting just how compressed that 2025 free cash flow number became against a backdrop of aggressive AI-driven capital spending. The market is pricing in a future that is bright, dominant, and decades long. The DCF says that future may already be more than fully priced in. 4 risks every Amazon shareholder needs to understand. First, AI infrastructure spending. Amazon is pouring capital into data centers and custom silicon to compete in the AI race. That spending crushed free cash flow to $7.70 billion in 2025. If returns on that investment disappoint or take longer than expected, margins and cash generation will suffer. Second, AWS competitive pressure. Microsoft Azure and Google Cloud are fighting hard for enterprise cloud contracts. Any meaningful share loss in AWS, which anchors Amazon's operating profit, would hit the stock disproportionately hard. Third, regulatory exposure. Amazon faces antitrust scrutiny across the United States and Europe, targeting both its marketplace practices and its dual role as a platform operator and a direct competitor to third-party sellers. A forced structural change would be a significant event. Fourth, valuation risk. At 319.6 times free cash flow, any guidance miss or macro slowdown gives the market an excuse to reprice aggressively. Now the catalysts. AWS AI monetization is accelerating. Amazon Bedrock, custom Trinium chips, and enterprise AI contracts represent a material new revenue layer that is still early innings. Advertising is a high-margin, fast-growing business that the market continues to undervalue inside the Amazon umbrella. International profitability is improving, with previously loss-making regions beginning to contribute meaningfully to operating income. And Prime membership expansion, both in penetration and in per-member monetization, continues to deepen the moat around the consumer business. The verdict on Amazon is buy. And here is how to think about that honestly. The bull case. AWS becomes the dominant AI infrastructure layer of the global economy. Advertising scales into a standalone powerhouse, and international markets finally deliver the profits they have long promised. That is a $106.37 business, maybe more. The bear case. Capital spending spirals, cloud competition bites, and regulatory action reshapes the marketplace model. That gets you to $78.62. The base case sits at $92.50 per share, less than half of today's price. Amazon is a great business, possibly one of the greatest ever built. But great businesses and great stocks are not the same thing, and right now the price demands near-perfect execution for decades to justify the entry point. Watch the free cash flow recovery. Watch AWS growth rates. The story is compelling. The price is the risk. If you found this break